Are we on the edge of a market meltdown as history repeats itself?
We're bringing you powerful insights from top-tier experts, including the renowned Gary Wagner.
And the best part, you're getting the distilled wisdom in just minutes.
Absolutely. Discover why the debt crisis could impact your investment portfolio.
Welcome to Financial Insights in Minutes, where saving time leads to smarter investing.
Stay tuned as we reveal the bullish outlook for gold and what it means for you.
But first, let's dive into Bravo's research, addressing the potential market melt-up. Today's discussion centers around the term stock market melt-up, a phrase being tossed around by experts with opinions all over the map.
Indeed, a recent chart of the S&P 500 shows an aggressive uptrend, yielding a remarkable 40% return just since last October.
What's the core thesis being laid out here?
While these gains are significant, history shows that major melt-ups aren't always sustainable and often lead to downturns.
So it's this dichotomy between excitement and caution.
Exactly. Today's market is similar to those of 1999 and 1929, making it a critical time for evaluation.
Fascinating history. What makes this instance unique?
The recent 40% gain in a year is rare, only seen 15 times since 1927.
Now let's address valuation. What's the current situation for the S&P 500?
It's concerning. The Shiller PE ratio indicates a high valuation of 37, suggesting lower returns ahead.
How are corporate profit margins shaping these predictions?
They've grown due to technology advancements, but we need to remember that they can contract during recessions.
What does the future hold? Any predictions?
We expect high valuations to deflate eventually, which could lead to lower returns in the upcoming years.
Given these insights, what's the recommended strategy for investors?
The advice has been clear. Don't fight the trend. Utilize dips as buying opportunities.
And the most poignant prediction, what should viewers keep an eye on?
As we anticipate a recession, anticipating market corrections should be key to decisions.
With so much uncertainty, should investors remain hopeful?
Yes, despite the risks, the current environment could still yield gains before any downturns.
To wrap things up, what's the essential takeaway here?
Being cautious is crucial while seeking opportunities in the market.
Balancing the risks and rewards accurately seems pivotal.
That's right. It's about navigating intelligently through this market landscape.
In this insightful video, we explore the real debt crisis that seems to be flying under the radar. It's time to pay attention.
Indeed, the crisis is global, with implications reaching from the US to Japan, yet it's hardly discussed.
What's at the heart of the debt crisis, according to the video?
The argument revolves around the paradox where increasing debt leads to greater inefficiencies in the economy.
So they're actually suggesting that debt intensifies the problem instead of alleviating it.
Exactly, it's a cycle where more government spending leads to worse economic conditions.
One key point made is about the effectiveness of government spending. How does it actually impact the economy?
It often does not stimulate recovery. Instead, it makes the underlying situations worse.
The video challenges the idea that high debt is synonymous with inflation. Can you elaborate on that?
Sure. It explains that inflation often arises from supply shocks, not just debt levels.
Japan is used as a case study. What's the takeaway from their experience?
Despite soaring debt, Japan did not experience the anticipated inflation or economic improvement.
China's current situation is alarming. How does it compare to Japan?
Similar patterns emerge. Government spending has failed to address underlying economic weaknesses.
How does political maneuvering play into this debt crisis?
Politicians are not penalized for excessive spending. Instead, they gain support.
What predictions are being made regarding government spending?
There's a forecast that spending will increase, further worsening economic conditions.
Sounds like a troubling cycle is about to repeat.
Exactly, the system perpetuates itself.
Wrapping things up, what are the main takeaways viewers should grasp?
It's crucial to recognize how debt-laden policies can deter real recovery and innovation.
And addressing political accountability seems pivotal for real change.
Absolutely. The only way out is through responsible voting.
In a video featuring Gary Wagner, he dives into the current precious metals market, showcasing gold's rise past $2,700 and silver's impressive 12-year high.
Gary emphasizes that geopolitical tensions and economic factors are significantly impacting these surges, keeping viewers on edge.
So, what's Gary's main argument about the factors behind these surges?
He essentially points to ongoing geopolitical conflicts and the Fed's signals around interest rate adjustments.
That sounds like a volatile mix for investors. How does he see these trends shaping up?
With strong safe haven demand for gold due to the uncertainty, Gary is bullish about significant price increases.
Gary suggests that rising tensions are making gold more appealing. What's the latest?
Indeed, the geopolitical climate is fueling demand. It's a classic flight to safety.
And what are the bullish predictions for gold and silver?
Gary revises his forecast for gold upwards and sees significant potential for silver's price rise.
How does Gary evaluate the Fed's recent approach to rate adjustments?
He sees the intention to stabilize rates as positive for gold's outlook, signaling a long-term bullish trend.
With elections around the corner, how might that influence market behavior?
Gary indicates that political outcomes could drive volatility in precious metals, impacting investor sentiment.
What's Gary's bullish target for gold?
He aims for $2,865, emphasizing the need for ongoing tension to maintain this trajectory.
Any predictions on the silver market?
Yes, Gary forecasts a surge to around $42, supported by momentum from recent highs.
In conclusion, what key takeaway should viewers remember?
Stay alert to geopolitical changes and Fed actions. These will steer the precious metals market in the coming months.
Great advice. Keeping an eye on both global and economic factors is crucial. In this summary, we'll explore key economic insights shared by a range of experts during Thoughtful Money's recent online conference.
They unpacked everything from consumer spending trends to the ramifications of fiscal policies.
So what's the core thesis presented?
They argue that a significant inconsistency is forming. Money supply is increasing, yet GDP growth isn't keeping pace, leading to risks of economic downturn.
Interesting. What implications does that have for market participants?
If this trend continues, we could witness underwhelming economic performance alongside deflationary risks.
How about consumer spending? What's the situation there?
Consumers are feeling the pinch. Essential purchases like food and energy are overshadowing discretionary spending.
And what about the huge investments in AI we're hearing about?
Experts warn that many AI projects aren't yielding tangible returns, which could drag down associated stock valuations.
What economic factors are causing the most concern?
Debt and excessive monetary accommodation are leading to distorted markets and inequalities.
How do experts see the market moving towards the end of the year?
While some forecast a Goldilocks economy, others express skepticism over the sustainability of recent gains.
Any predictions for commodities markets?
Yes, there's a bullish sentiment around gold and other commodities, but experts caution about volatility ahead.
What should investors brace for in the upcoming months?
Experts predict ongoing uncertainty, with fluctuating consumer confidence impacting market dynamics.
Is now a good time to invest in commodities?
Many believe so, especially in gold, but preparation for a bumpy ride is vital.
So what's the takeaway for our viewers?
Stay cautious, but remain on the lookout for strategic investment opportunities as the market evolves.
Balancing caution with opportunity, especially in uncertain times, seems essential.
Absolutely. It's about navigating these waters with foresight and strategy.
Today, we're diving into the latest pre-market prep, not just for the trends, but also the challenges traders are facing ahead.
With interest rates spiking, the market's feeling some pressure. What's the inside scoop?
What does the current economic backdrop suggest for traders?
With rising interest rates, we may be on the brink of a downturn. Historically, these conditions can create turbulence.
That's alarming. What are traders supposed to navigate through all of this?
Understanding the fluctuations and planning for volatility is key. It's like sailing through a storm without capsizing.
Let's dissect how rising interest rates affect market trends today.
Exactly. Traders are feeling the heat, with S&P futures down by 45 basis points.
So what does this mean for investor strategies?
It suggests caution. Adjusting risk management is crucial.
The earnings reports are out. How are they affecting the market?
Well, Verizon's struggling, while GM's guidance is impressing, showing a mixed bag overall.
So companies are reacting differently to market conditions.
Exactly. It highlights the need for selective trading strategies.
What are you noticing on the charts this morning?
We're at pivotal levels. Traders must be ready for possible retracements.
That makes sense. How should traders position themselves?
Staying vigilant around key support levels is essential.
Looking ahead, what should traders prepare for?
Predictions lean towards more volatility. Earnings can shake things up.
And which sectors should traders keep an eye on?
Tech stocks often lead the charge. Traditionally, they are sensitive to economic shifts.
What's the SP 500 looking at for the next few weeks?
Analysts predict a drop if bearish trends persist, watching for signs.
That's a significant outlook. What could trigger this?
Earnings results and how traders react will dictate the momentum.
How about the tech sector? What's the forecast?
It's at a critical juncture. Expect volatility as interest rates are weighing heavy.
Tech has been the backbone historically, right?
Exactly, but this pressure changes the game landscape.
So what's the key takeaway for traders?
Caution and strategic adjustments are paramount in this climate.
And keeping track of key indicators can provide clearer insight, right?
Absolutely. This helps in making informed trade decisions moving forward.
In today's analysis, we'll explore some intriguing market trends and predictions that were highlighted in FX Evolution's latest video. Let's dive in.
This video really shines a light on what's happening beneath the surface, including rising 10-year yields and its implications for different asset classes. The core thesis suggests we might be mirroring market trends from the 1960s or 1990s, anticipating a potential pullback as we head into 2025.
That's definitely a bold claim. What specific signs are pointing towards such a downturn?
Well, high valuations and rising yields could create an environment for a significant market correction.
Let's start with market sentiment. How does it compare to the historical context?
The parallels drawn to the roaring markets of the 1960s suggest that a correction is likely due if history repeats itself.
What economic indicators should we be keeping an eye on?
The skyrocketing 10-year yield and dark pool liquidity are significant. They indicate potential selling pressure in equities.
And regarding potential pullbacks, what historical insights can we draw from?
Typically, after prolonged market gains, corrections like a 10 to 20% drop are common. Our analysis hints we're due for one.
What are the current predictions for key assets, especially in technology?
Stocks like Nvidia are expected to lead the way, but caution is advised in sectors like home building, given recent trends.
How do political events factor into market predictions?
Elections typically disrupt markets, but historically, they often recover quickly post-election, so adaptability is key.
Looking ahead, the predictions point towards a correction in 2025. What's the reasoning behind this?
Historical trends show downturns typically occur after sustained highs. Combined with current economic signals, it is a plausible scenario.
What's in store for tech stocks like Nvidia?
Nvidia is set to remain a leader. It's heavily influenced by AI advancements and investor sentiment.
To wrap up, what key takeaways should investors focus on from this analysis?
Be prepared for market volatility and potential corrections, but seek opportunities amidst uncertainty.
It's all about balancing caution with insightful investment strategies. Now that we've wrapped up our expert insights, it's clear that we're facing a uniquely complex market scenario.
Absolutely. Gary Wagner's bullish outlook on gold contrasts sharply with Matt's concerns about inflation, creating market corrections.
And let's not overlook the Bravos research team's take on the S&P 500. It is under a lot of pressure from interest rates.
Right, it's a real tightrope walk for investors right now.
So, whether you're bullish on gold or anxious about inflation, there's something for every investor in today's analysis.
Absolutely. If you found value in these insights, don't forget to like and subscribe. It keeps our channel thriving and ensures you won't miss any crucial updates.
And there you have it. Stay informed, invest wisely, and make sure to check out our other videos for even more financial strategies.
Thanks for tuning in, and we'll see you next time.